Interested in real estate? How about wealth? Well, they go hand in hand. And here, you'll learn all about it. Welcome to Be the Bank, a podcast where we discuss and debate the topics centered around real estate investing. Your host, Justin Bogard, shares insights into investing in real estate to create real wealth and passive income for you and your family. He'll share stories of real estate investments done right, walk you through the process of owning a real estate note, and most importantly, educate you so you can be the bank. This is Be the Bank, brought to you by Bright Path Notes. Now, here's your host, Justin Bogard.
Hello, everybody. I'm Justin Bogard, your host of the Be the Bank podcast. And today, we're going to get into the home affordability aspect of what's going on, the rising of interest rates. And I got my friend Richard Thornton on today. So I look forward to having this chat with him. And stay tuned. This is episode number 13, and it's brought to you by Bright Path Notes. Richard Louise Thornton, how are you?
Louise, don't know about that, but
I got my jab in first, Richard.
You did. Well, I am camping out downstairs today because yesterday it was a whopping 104 degrees here in Northern California, which I'm sure will not be good for the wildfires. Oh,
right, yeah.
It dries everything out, and although I don't know if you've been reading about it, the one largest fire right now in the U.S. Was actually two fires, and it is united, and it was set by the fire department as a controlled burn. It's burned down over 500 homes, and people are just furious about it. So I feel badly for those folks.
Okay, that is very interesting.
Mm-hmm.
Well, it's 100. It was 104 yesterday. Is it going to be over 100 today?
It's supposed to be right about that, yes. And it's supposed to be cooling to a mere 97 tomorrow.
Cool.
But yeah, I mean, usually the Petaluma area here north of San Francisco gets warm, but then it cools off because we've got an onshore breeze. So it's kind of like I don't know if you've ever lived in the coast, but what we call beach weather, which is you can have really nice warm days, but then an onshore breeze comes on and it's chilly at night. That's the usual Petaluma weather, but we're not experiencing that right now.
So then you could open up your windows and get all that hot air out of there pretty quickly towards the night, and you can cool off the house. So at least the half the morning will be nice, right?
You could, but that does not seem to be occurring at the moment. So,
well, we're both kind of in remote locations. I'm staying with a friend this week that I'm visiting in southern, kind of south of Indianapolis. And so, as you can see in the background, this isn't the typical team that I support. He's a huge Ohio State Buckeyes fan. And I'm going to tell you, this guy is he's a diehard fan. I mean, you think of anything you can have that could have your team's name and logo on it, this guy has it. So,
I'm sure he knows all the stats, right, of all everybody. And
yeah, so college football is like his thing. So he's got all the college football national championship, Sports Illustrated issues and stuff. So he's definitely a diehard fan. I have to commend him because he's been that way pretty much ever since I've known him, since back in grade school and stuff.
So he doesn't have any of the Sports Illustrated magazines that show women on the cover, though, right? You would never do anything like that.
No, it's just sports, just football.
It's just sports. Okay.
It's always good sports. Actually, he just buys it and then he puts it right into a glass case, if you will, like a framed case, so it stays intact. So he's pretty cool. Anyways, that's why you see this stuff in the background. I got to represent Purdue. Unfortunately, found out yesterday that a Purdue basketball player passed away. Yesterday or the day before. His name's Caleb Swanigan.
I saw
it. Basketball player.
25. Why? How did that occur?
Well, I didn't read the entire article. I just kind of saw it last night quickly. Someone actually sent it to me, and I think it was natural causes. I'm not real sure, but it's kind of sad. But he's a good basketball player. Seemed like a great kid and stuff. But yeah, I think in 2017 was his last year at Purdue, I believe. But yeah, it's kind of stinks. But anyways, we're not here to talk about that. We're here to talk about home affordability and mortgage rates. So, Richard, excuse me. I don't know if you are aware, today's 30-year mortgage interest rate, and we are recording this as of June 22nd, 2022. It is 6.05% for a 30-year average conventional mortgage for the national average. Obviously, you'll see some banks and credit unions be a little bit higher, a little bit lower, but that's the average rate.
Yeah, that sounds about right. I get rates posted from 2 or 3 different bankers here in the area, and they're ranging anywhere from 5.7 to 5.9%. So if the national average is 6, I'm not surprised.
Nice. The 15-year fixed average rate is 5.33%. So that's quite a bit of a jump between 30 and the 15 rate.
Right. So it's interesting. I mean, obviously they jumped because the Fed raised Fed borrowing rate to 0.75 of a point last week or recently. So that is what that is reflecting. But it's also saying that investors do not expect that rate to last, because if they did, the short-term rate, the 15-year rate, would not be lower. It would be up closer to the 30-year rate.
Okay, that's a pretty cool stat there. So let's talk about the affordability and how this affects. So, Richard, in general, the 6% interest rate in the scheme of the entire, let's say, the mortgage system of the United States is not that dramatic, right? We've seen mortgage rates in the close to 20% in the 80s, and it kind of hung out there. 6% was pretty much the interest rate before the crash of 08, 09, correct?
Yes, and you weren't in the market early enough to judge this, but when I first started lending, one of my first jobs was a lending job in the early 70s. And at that point, mortgage interest rates had hovered between 5 and 6 for 30 years. I mean, the fluctuations that we've seen since that time were unheard of. They just sort of bobbed along, and it was a very stable market. So 6% historically it's not a high rate. When you get north of 10%, then you're going to shut down the economy. And I have to admit that we're in a very different economy now than we were then. We're in a global economy as opposed to just a U.S. economy. Right. So I don't expect rates to go that much higher, because that would truly shut down the economy. When coupled with the oil prices, I don't know if you've I'm trying to go to Seattle to see my daughter here in July, and I just found out that the airfare had doubled since I went last time. Yeah. And a lot of that's due to gas prices.
Right. So the 6% is kind of what I experienced when I actually got my first home mortgage, which, I don't know when that was, 2004, 2003, 2004. And it was around 6, I think it was 6.25 is what I ended up having for mine. And I believe mine was an FHA loan as well at the time, my first home mortgage. So let's talk about what this does. So a few months ago, Richard, it had been as low as, let's just call it 3%. Maybe it's a little bit lower, maybe it's a little bit higher. Let's call it about 3%. And so that 3%, it had been hovering there since probably, Richard, about 2015, 2016. It started dipping well below 4% and kind of hanging in there, getting close to 2, then backing up to 4, just kind of floating back and forth for a while until finally it's jumped up to basically 6 today. So we have a country, and we have been very used to having a low interest rate. So we feel like this is just, a horrible thing, right? Right. We've been getting away with a very low interest rate, which causes us to be able to afford more of a house payment.
Right. Right.
Go ahead. You were going to say something.
Go ahead.
I was going to say, my question to you, Richard, is what is about the average median price home in the Petaluma area out where you live?
Well, interesting that you would ask. The Bay Area median is about $860,000.
Okay.
Petaluma is supposed to be less than that, but actually in this part of Petaluma that I'm in, I think it's closer to 920.
Let's call it 920.
Mm-hmm.
Let's take that. Today's interest rate is 6%.
Mm-hmm.
And on a 30-year fixed mortgage, the payment would be $5,515.86. So we'll call it $5,500.
Right. So that's quite a bite.
That
That's
is a big bite.
$60,000 a year. That's
That's
a lot.
assuming you had the mortgage. Let's not assume the mortgage was 920. Let's just take 100 grand off there, Richard. Let's just call it 820. Okay.
Okay.
Because there's going to be a sizable down payment, right, for this.
Right.
Let's just call it that. So the payment, let's just call it 5,000. It's going to be 4,900 and some change. Let's call it 5,000.
Mm-hmm.
So which isn't the point I'm trying to make. The point I'm trying to make is to show us how this affordability really just totally changes your family's financials. So we go from a 6% to a 3% rate. Let's just say 4 months ago it's 3%, and so that payment goes from 5,000 to 3,500.
Mm-hmm.
Pretty big swing.
Pretty big swing. And on that, I mean, if you look at it, let's talk about qualifying for that mortgage. So to qualify for a Fannie or Freddie, that number can only be 33% of your gross or 45% of your total debt limit. Well, if it's 33% and your mortgage payments are $60,000 a month, I'm sorry, $60,000 a year. The first aspect of that is if you're in the 30% tax bracket, that means your payments, very rough math. I mean, you've got to be earning about $90,000 a year just to make your mortgage, to cover no other cost whatsoever. And I don't know if you've got a calculator, plug that in. What is, if it's $60,000 and that's 33%, what's your income got to be to qualify?
33% of 60,000, is that what you said?
Yeah. Mm-hmm.
So that's 33% of 60,000 is about $20,000.
No, I'm sorry. That $60,000 can only be 33% of your income. So divide it by.
Gotcha. I misunderstood you. Sorry, I had to lean in on my computer. 181,000.
So you got to make 100. You got to have to be making 180,000 just to make your mortgage payment here in the Bay Area.
Wow.
Tell us about Indianapolis.
Well, that's a little bit different housing market here. So I don't know what the exact number is, but I'm going to call it 275 for the average price home in general for the Indianapolis and greater Indianapolis area, which is going to encompass a couple of affluent areas and a couple of poorer areas. So we're just kind of getting the big gambit here. And so we'll call it 275 is the average price home. Let's call it 300 is the average price home with a down payment of, let's say, 50,000. So we'll just have a 250 loan amount. Let's just make some round numbers just so that the math comes out a little bit easier for us in the calculator. And so we said a 6% rate was today, 360 month mortgage. That payment's about $1,500.
Mm-hmm. That's still pretty steep.
Yeah, it's pretty steep. So I want to say the average paying job is probably, more along the lines of 40 to 60,000, depending on. So you could have multiple incomes in the same house, or it could be one income. Let's go to 3% interest rate. This is what you get for doing calculations on the fly here. So it's about $1,000, about $1,050. So it went from $1,500 to $1,050. So $450 swing in a monthly payment, which, $450 here in the Indianapolis area or the Indiana area, your electric bills are going to be anywhere from $100 to $200 for the summer, right there. So that's a huge difference as far as comparing it to other utilities and stuff. So having the 3% interest rate will allow you to afford, obviously, to pay other utilities and stuff. So that's what the swing is here. It's about $450.
Right. So since the median income last year, which is latest year that we have stats for, in the U.S. was only $33,000, it makes it pretty tough for many people to own a house. Now, you can buy a nice little house for $100,000 in some little podunk town, or rural, I guess I should say. But it makes it difficult. And I think that's part of the reason that we're seeing that the millennials are buying so few houses. I mean, the
Okay.
renters portion and the rental market is going crazy in the US. I used to finance a lot of apartments, and I syndicated a few small apartment deals, and I got out of it because there was just um, so many people looking for those deals, and cap rates were getting beaten to death.
Right.
Uh, but that has since turned around, since millennials have not been able to buy, demand is way up, rents are way up, and home ownership is way down. Matter of fact, I read something earlier that said that only 17% of millennials are able to afford a house.
Wow. That's a pretty low number.
Mm-hmm.
So it's tough for them to afford the house. And then number two, do they want the house? Do they want to be homeowners? I wonder if there's data on that to show. It seems like the millennial or the generation that's after the millennial who's coming in through the mix. I don't know if that's called Gen Z. I can't remember what the generations are called now. But is it, they don't want the maintenance of the house, right? Maybe they
Right.
want the more of the condominium style where the HOA is kind of taking care of all the things from the outside. They want to be in more of a community that can walk to different places. For the downtown Indianapolis millennials and the generation after them, let's just call it, that's exactly what they want to do, and they love it. They don't mind the smaller space. They want to be able to walk to places or to ride a bike or the Lime scooter that you can rent off of your app and take that
Right.
from place to place because they like that part of it. So I can see it being both factors. Obviously, affordability is pretty apparent, but also the fact that do they really want to own a house?
Well, yeah. I mean, to me, that's always it's always going to be anecdotal to answer
Mhm.
that. I just think it's a very interesting trade-off. I
Yeah.
tend to be somebody who likes to have my space the
Yeah.
way I like to have it. In other words, if I want a wall that's pink or green or blue and I want to move it from here to there or decorate it accordingly, that's part of my living environment. But if you're renting, you don't necessarily have that choice to do that. And so they're obviously willing to give that up for that lifestyle. I
Yeah.
think part of that may go with the fact that a lot of people are adopting more of the European model, which is you don't live in your house so much. You spend most of your social time is spent outside. You're outside of cafes. You're outside doing things. Um, and so that's a whole different cultural lifestyle.
Yeah, you're right. It is, and it makes sense logically when you think about it. Like, if I'm not in my home 24/7, do I really need to have a big home? Do I need to have a big payment? But it's all in your, I guess, your wants and needs, right? When it comes down to
Right. So I think, though, that's going to change once
it.
the millennials start to age a little bit and start to get families,
Yeah,
because it's very tough to raise two or three kids um, in an apartment.
yeah,
You
yeah.
can do
You're
that,
exactly right.
obviously. It's done all the time, but you got to have places for the kids to play, and it's much nicer to be in a single family home.
Exactly. Yeah, exactly. So the question I get asked often, Richard, in this new mortgage rate economy that we're in, is the question gets asked, Justin, how does this affect what you do for a living and investing in mortgages? Does this affect you in any way? And my answer is usually a pretty much blanket statement, is that it doesn't affect us too much as far as myself being an investor. It obviously affects the consumer, the person that needs to get the mortgage or the help to finance the home. It doesn't affect us too much because there's just so much of it out there and so few of us that can buy these, that we don't really see a squeeze, if you will, of of that market share.
Right. So I would agree with that. Do you find, though, that your investors are wanting higher rates of return because interest rates in general are up?
I don't get that question asked too often. It's usually the investor that expects a certain rate of return, or maybe it's kind of unreasonable. Let's just call it double-digit returns and higher. It depends on how much effort they put into it. So I don't get that question posed to me too often. They kind of have a return on time in mind, if you will. So they're looking for a vehicle that just invests their money, and then they're looking for a consistent rate of return and a predictable income stream that's coming in, and that's usually their satisfaction. So to answer your question, unfortunately, I know I'm getting around it. It's really kind of no-ish. People are happy with the highest return they can get with the most money they can put into it, right? But at the end of the day, the old cliche is what I tell people is like, well, how much activity do you want to be involved in this? And if you don't want much activity, then this is where you're going to be. And the risk is minimal, right? The risk is low, the security is high, and the payment is a constant stream of cash flow. That fits your wheelhouse. So it comes down to what I call the three different buckets that people kind of fall into. So the ones that are more active, that want to be more active with a higher return, then they have to kind of harvest their own inventory. If we're out there looking for them, then they got to share some of that return.
What I thought is interesting is that a number of not my clients, but people that are or want to be clients seem to have the 12% return number stuck in their head. So 5 or 6 years ago, when rates were a lot higher, they said, sorry, I forgot to turn off my phone.
Well, we're on live TV.
That's right. See, they said that they wanted a 12% return. And then that's when rates were, 8, 9%. Then rates fell down to 2%, 3%, and they still wanted a 12% return. They were not adjusting accordingly. Doesn't work that way, as you well know, especially since stuff becomes more what we offer anyway. I sold 2 notes yesterday to somebody, and one was at a 23%, the other one was at a 33% investment to value. I mean, you're just not going to get more than like a 5% return on anything like that.
Right, because the risk is low. If the risk is low, you can't expect a large return because it's a very highly secured, low risk. I don't like to use the word safe, so I'm trying to purposely avoid that word, right?
Right.
Yeah, it makes sense, right? High risk, high profits. That's kind of the old saying there.
Right.
So, Richard, I don't know where I was going with that that last thought, but I wanted to get your input on it.
Well, so I mean, what I would say is that a lot of people don't account for risk. Those people who say, "Gee, I want a 12% return," you make the argument, as you stated broadly, about risk and return. What they don't realize is that a lot of those 12% returns, they're totally over leveraged. A lot of people think, "Oh, gee, I can get into a private money loan. I can work with somebody to flip a house." Let's think about that. Let's use lower numbers than I would here in the Bay Area, but probably higher than you may have.
Okay.
You buy a house for $200,000 that needs a lot of work, and you get a good price on it. But if you had to put it on the market as it was, it might be worth $225,000, but you got it for $2. And so they have to put in $75,000 to make it presentable to today's standards. So they're at $275,000, and there's a period during that renovation where they've got a house that's actually worth less than $200,000 because it's all ripped apart for renovation. If for some reason your contractor folded, got hit by a truck or whatever, if you tried to sell that house at that time or get another contractor to come back in and finish the job, which I have had to do, and it is not pleasant at all, it might be worth $150,000. So they don't take into account that they are way over leveraged during that period. And they're always looking at I'm going to make X amount of money later on. Well, not necessarily.
Richard, that is an excellent point, and that's something that I haven't pointed out to people before, and you did a great explanation of that, because you're exactly right. That's why the what do we call this? The private lending or the hard money lending aspect of it is such a high return, because you're expecting that velocity of money to come back a lot sooner. And then also you're taking on just an inordinate amount of risk right there, because you're exactly right. Will that happen every time? No, but it can happen, and it's probably happened to a lot more people than we realize. So there's also that yield drag effect, right? With the hard money lending, it's like, yeah, you can get this, air quotes here for folks that are listening on the podcast and not viewing us here. is the 12%, hard money rule, like you just brought up. So yeah, you can make 12% on that specific project, but what happens when you're waiting from the end of that project to the beginning of the next project that your money's deploying? You may have a couple of months of drag time that takes that 12% down even further. So you end up making, let's say you net 8% on it and the risk was really high. Wouldn't you
Right.
rather have an 8% or 7% return on something that's a very low risk situation and it's not a variable change and it's across a longer period of time? It's a very consistent, predictable cash flow. That's our argument against it.
Yeah, very much so. And a lot of people get greedy for yield. And so I'm buying a note right now that I'm getting a very good return on. I'm probably going to get like a 19% return on it. That's great. It's not that big a note. It's like a $34,000, $35,000 note. But I looked at it over the term and I'm only making $2,000 on that note at that return. So the actual dollar return is not that great. Yeah, it's a great yield, but you really have to look at it in terms of what do you have at the end of the day? The term is not that long on it. It's only got a couple of years left on it. So I would much rather put it out and get a lower return, get a 10 and 12% return or lower for a longer period because my money's going to be working for me longer.
Exactly. Yeah, looking at a note portfolio is a little bit different than just saying, I want to average my portfolio of X amount of return. Yeah, that's easy math. That's a crude way of looking at it. But there are other factors, Richard, that you just brought light to that you need to take into consideration. What's the risk on it? I tell people all the time, I have single digit return notes on purpose because the risk is so low. And I keep some of those in my portfolio for that reason, because it can help me absorb some challenges in the future with other higher risk notes that I have in our portfolio that may project, a lot higher return. We'll call it, a 15% return or higher maybe. But there's a lot of risk there. There's a lot of opportunity for things can go wrong. But it's also, the bottom of the ninth with 2 outs, and you got your fourth position batter up there ready to knock it out of the park for a grand slam to win the game when you're down by 3 runs, right? So those are the situations that you look at the note portfolio and you kind of put the pieces of the puzzle in there.
Right. And so the other thing that I didn't mention about the private money loans and shorter term and getting 12% return is that it doesn't have to be something that's catastrophic. At one point, as you know, I flipped houses. And we did have a period in about 2014, 2015, that here in the Bay Area, the market just stalled. Didn't collapse. It's just like it just went into pause mode. And I realized that I had an enormous amount, because I had 9 houses going at once, enormous amount of negative drag. And there was a very good possibility that I wasn't going to make any money on any of those houses. Not because of anything catastrophic, but just because all of a sudden it was going to take me maybe 3 months. Market slowed down a little bit. It was going to take me 3 months to sell the house. And my debt service was eating me alive before I could sell the property. So, you got to put all that into consideration. And right in today's market, that is very much a possibility, because a lot of these buyers on flipped houses are going to have to try and qualify for conventional mortgages that are going to be at the 6% that you mentioned at the opening.
These are very good points. I know we got derailed from our affordability concept, but I'm glad that you brought up about the investors, because it is a good conversation to have. And it's something that, we don't get a chance to talk about too often, to defend on why it's not an apples to apples comparison. And I think we've illustrated really well about the risk there.
Yeah. So Richard, and it does all, as you say, it does all get down to affordability. As soon as the rates go up, your payments are larger, your down payment's got to be larger. And if you don't have somebody, if you don't have the money yourself, or here in the Bay Area, what we find is a lot of grandparents are making pretty big investments in their kids' houses for them, so that they can get on the train.
All right. Richard, we're going to take a quick break. We'll be right back. This episode number 13 is brought to you by Bright Path Notes, and we're going to have a little bit of fun after this. Richard, thanks again for being on the podcast today. thanks again for being my kind of partner in crime. I know we haven't talked about it too much, but we kind of joined forces not too long ago, about a year ago, I think, as far as trying to build a portfolio together and using our sources and our resources and our network to kind of come together and do things. And we've been going after a lot of seller finance notes, meaning people that create these seller finance land contracts or these note and mortgages or note and deed of trust, depending on what state you're in. And we've had kind of a bit of fun in doing that. And you are on the front end of the line here, as far as you are talking with the potential note seller, and you are getting information. You're hearing these really amazing stories, and sometimes they're funny, sometimes they're sad. And then I had the luxury of just doing the back end office work with all the other stuff that we do. And my question to you is just to bring a little bit of humor into this. Is you get to experience a lot of the psychological part of doing the deal, right? Getting creative with trying to get to understand someone's pain on how you can solve that problem. And in doing so, I know you get a lot of extra information from the seller that may not be that important to the deal, but it's just kind of neat to understand. And so, some of the stories that you've gotten that you've told me, I'd like to, maybe talk about one or two just for fun. And so, come to mind. This is off the top of your head. I know I didn't plan on. I know you didn't plan on me asking this question, but what are some of the fun stories that you've heard recently? And I know you've been doing a lot of marketing in Texas, just because it's interesting to hear your stories from different states on how people sound, how they react, how their mannerisms are. And so, what have you heard from Texas so far? That's a story to where someone has gotten into a deal and they're ready to sell it, and the reasons why to sell it.
Well, I get a lot of divorce stories, a lot of hey, my wife got the house. I don't have anything. And then I get these crying type of emojis. There's more divorce-driven note sales out there and home sales than you'd like to believe. I did get a humorous response yesterday. I was talking to somebody. I had gotten their phone number, and we texted back and forth just before we had a phone call. And the person said, "Bro, I'm only 13. I don't have a house yet." And I texted him back and I said, "What? 13? You don't have a house yet? You should have at least 2." And so we went back and forth like that. And, there are some people out there who like to have fun. Some things like that. So yeah,
I'm sure there's people on the opposite end of the spectrum, and we won't bring that to the call today. But yeah, those are funny. Richard, I wanted to bring one last thing into this before we close today, and to talk about seller financiers, and we were talking with them, because you tell me these stories and you get me kind of caught up to how the transaction came to be, how you were able to sell it, what their challenges and issues are, and then I get to talk with them on the phone after that during the process of we'll call it closing, going through the discovery. I'm looking at the documentation stuff, asking questions, and you'll tell me, "Oh yeah, this person is awesome. This is who they are." You give me kind of a general idea of the type of person. Sometimes I get on the phone and it's not the same thing. As far as not meaning anything bad, it's funny how when you talk to somebody, you may see this person a different way. When I talk to them, maybe they're a little bit different. So I'm wondering if it's the passing of the baton that changes kind of their attitude a little bit. But anyways, I think that's just a good salesmanship in you, maybe a poor salesmanship in me.
No, I don't think so. I think you're right. I think it's one is sort of anticipation, because they in a lot of cases want to be nice to me because I haven't given them a price yet. So they're sort of on their best now. And you're right, though. We do get the responses anywhere from a realtor who wants to sell 3 or 4 properties, or sell the notes so they can buy another property, and they're very quick and on top of it. We get Ebenezer, who's 83 and quite can't hear what you're saying, and doesn't quite get it. And we get the lady, as you know, who has had, and I'm not kidding, 5 husbands and she's estranged from her sister, and her sister is renting the house or bought the note for her and is no longer paying. And you get into these domestic stories and you go, I don't believe it. I don't believe that people
Yeah.
live like this. So it's
Yeah.
all over the map. It's I have to admit, it is kind of fun sometimes.
With all that said in mind, and I know you agree with me when I say this, it's really a joy when you're able to commence the sale, because you know you've gotten that seller exactly what they wanted. They're happy with getting the problem solved, if you will, which is releasing themselves of the liability of being the lender, if you will. And then also, you know that you have a borrower that's appreciative of the fact that now I can have a loan that's kind of professionally serviced and it's following the rules, so they know that, they understand they're not going to get away with certain things, but they also know that they're held to the standards and the regulations of the CFPB, the Consumer Financial Protection Bureau. And so it's kind of a win for the seller, a win for the borrower, and it's a win for us, obviously, because we're in this business to make money. And so we obviously can get our inventory that way. So at the end of the day, Richard, I really like what we do, and I'm really glad that you're doing it with me. And most of these stories are pretty fun.
Yeah. I mean, and you're right. I think in general, we are pleasing people. In general, we're helping them sort of get on with their lives. There's one fellow who's got married. His wife cheated on him. They got divorced. She got the house. He's tired of getting the payments because she's, basically she's jerking him around, not making the payments. So now he's going to get his full dollar, and she's going to basically have to not be able to jerk anybody around anymore. And it's just a lot nicer situation. So,
people take advantage of family and friends when they do deals. And so this is why when they offload that problem, they realize, okay, there's a new sheriff in town, if you will, and where the rules are going to be enforced now. So.
Yes, they are.
All right. Richard, thanks again for being on the podcast today, episode number 13, which is brought to you by Bright Path Notes, and we will see you next time.
Great. I always enjoy it. Let's do it again.
Thanks for listening to Be the Bank. We hope you learned something from today's show. If you enjoyed this episode, please rate and review us. Plus, check out our Bright Path Notes channel on YouTube and follow us on Facebook and Twitter at Be the Bank and on Instagram at Be the Bank Podcast. Be the Bank is sponsored by Bright Path Notes. Thanks again for listening.